Investors were expecting a bazooka from Chinese regulators this weekend, or at least a broadside against the sell-off gripping stock markets in China. Instead, regulators came to the gunfight with markets armed with nothing more than a bow and arrow, and they missed. Chinese stock markets have fallen sharply over the past few weeks, and try as they might, authorities haven't been able to stop the sell-off thus far. After selling resumed last week, many investors thought that this weekend would be crucial to restore confidence. So what did we get? Announced this weekend was a move allowing the Chinese pension fund to invest in local equities. That's a big step, but it's not what markets had been hoping for. But analysts had expected the People's Bank of China to unleash a tide of liquidity to prop up the markets, and that didn't happen. The result has been brutal and not limited to China. The selling started on Sunday when markets in the Middle East were open and Dubai's market fell by 7%. As Monday dawned, it became clear that this was going to be a bad day for Asian equity markets. Japan's Nikkei ended up closing down 4.6%. In Hong Kong, the Seng index was down as much as 5.7%, and in Taiwan, the benchmark there fell as much as 7.5%, an enormous move by any standards. When China proper opened up for trading, things got only worse. The Shanghai Composite, which had been up as much as 60% when it peaked in June, wiped out all of its year-to-date gains and is now down for the year after a daily loss of 8.5%. Thousands of stocks in China's markets closed the day hitting their maximum 10% limit down. So now the question becomes this. For Federal Reserve officials meeting in Jackson Hole for their annual symposium this week, is it really the right time to be thinking about raising interest rates at a time when China and the rest of Asia's markets are in complete disarray?